Welcome to Real Vision. I'm Maggie Lake. Here with me today is Emil Kalinowski, host of Eurodollar University with Jeff Snyder. And Emil's been doing a deep dive into some banking and debt data that can hopefully shed some light on countries that are at an elevated risk of a financial crisis. Emil, it's great to see you.
Thank you for having me on, Maggie. I've been a long-time Real Vision subscriber, commenter, and I can't wait to see what the audience feedback is in the comments section.
Absolutely. And I'm sure there's going to be a lot. Now, when I say a deep dive into this data, I am not kidding. I mean, you have been wading through some pretty intense data dumps from the BIS, the Bank for International Settlements. So I think it's worth maybe taking a step back and explaining a little bit about this information. What is it and why does the BIS release it?
Well, the BIS is a very helpful central bank, and it collates all the data from its member countries plus non-members to try to put together a picture of what the monetary order financial system looks like. And a few years ago, they announced the addition of two new measures of an early warning indicator for a systemic banking crisis. And they update this quarterly. And to your point, they update the data, but not always provide the easily digestible output. So you have to get in there and manage it some more. And that's what I did, and that's what I want to share with the audience. And the key that I want to share is they make it a point to say that it's a systemic banking crisis, right? Because there are several kinds of banking crises. We could have a bank run, Northern Rock, 2007. That's just one bank. We could have a lot of banks go down, but not be systemic, like the savings and loans in the United States in the late 1980s. They're saying, no, this is the real thing. This is what we are seeing here has the probability of spilling over the berms and washing out through the rest of the economy. So they're talking about 2008 kind of systemic national consequences.
Yeah. Fiscal kind of pandemic type thing that's going to affect everyone. So what are the components that we're going to be talking about that you had to look through? What are they using to get this early warning indicator?
So the early warning indicator, they give us 5, and each of them is tuned in such a way such that if the country trips a threshold, a countdown begins, a 3-year countdown whereby the probability of a financial crisis is 50%, at least historically. That's what they've observed. Now, just for the audience maybe wondering, well, isn't it always 50%? No, it's roughly 7%. Another group of researchers did a similar study, and they found that since the end of World War II until present time, any random year, any random country, 7% chance of financial crisis. And so here we've got a 50% chance, and they offer us 5 different measures. But the key that I think we need to start out with first is to make the point that this is looking at private debt.
Yes.
It's non-financial sector, private debt, households and businesses. It's not looking at the public side.
Yeah. Why is that so important?
Well, we have right now, if we were to look onto our metaphorical horizon, we have these 2 dark towers of debt looming over the global economy. One of them is public debt. It's at World War II era level highs. The other is private debt. And that also, it must be at least World War II era level highs or all-time history. We don't know because the data doesn't go back far enough. But the point is, the public also, it must be at least World War II era level highs or all-time history. We don't know because the data doesn't go back far enough. But the point is, the public debt is more, stable. It's stable. It causes the consequences of it. If we asked Carmen Reinhardt and Ken Rogoff in their 2010 book, 800 Years of Financial Crisis, they found if you have too much public debt, the consequences are, slower growth. Now, that's not the worst thing in the world. It's not great, but it's not the worst thing. Private debt is a teetering tower. These things come down regularly. And that's some of the lessons learned. That's the key lesson learned by one of your guests, on a Real Vision guest, Richard Vague. He wrote a book called 200 Years, A Brief History of Doom, in which he reviewed 200 years of financial crisis. it was a real pick-me-up for me.
Yeah, it's a real easy read, right?
I was in a dark place. I needed something to kind of cheer me up. And I said, A Brief History of Doom will do it for me.
That's why I'm laughing. But I mean, listen, you know, with the title, you get where he's going with it. I want to run through the components as we continue, and then correct me if I'm missing them or if I have them wrong. So, residential property prices, cross-border claims, credit gap, total debt service ratio, and household debt service ratio. Is that roughly what we're looking at? What you had to go through?
That's right. That's right. Which one should we start with?
So maybe break it down. Some of them come and they're a little bit easier to understand with the bank data, right? So maybe sort of start with those two, and then we'll go into the ones that you really had to sort of create your own charts and graphs with.
The credit to GDP gap. That's the easiest one. That's the most straightforward. That's the one they say is most predictive, according to their study. And it's basically taking a look at the debt to GDP ratio, the private, non-financial sector debt to the GDP, and saying, relative to your trend, to your national trend, are you far above it? And by far, they come up with a number, a threshold. And if you are far above it, then the countdown has begun. Your 3-year countdown, 50% chance. And so that's very straightforward. They're looking for systemic, nationwide surges. That's what Richard Vague in his book, he described all these financial crises. They come about by private debt being widespread, and you can't miss it. And that's what this measure does. You can't miss the surge.
Okay, so that one, they give it to us in fairly understandable. And what was the other one that they break down and that most of us could take a look at and understand?
So the first one, you can just press a hyperlink, and the answer is there. The second one, you got to do A minus B equals C, but it's still pretty simple, and that's the debt service ratio.
Right.
And there's two of them. There's the total private non-financial sector debt service ratio. So they're looking at your income versus how much you have to contribute to servicing your debt, both interest payments and amortization of the principal. They look at the total private non-financial sector. And then what they found in 2018 and released to us was they said, you know what? The household sector by itself also is predictive. And that's pretty straightforward. And they offer us pretty straightforward, A minus B equals C, and you can get an answer.
Right. And then after that is where it gets more complicated, right? What were the other components? Residential property prices.
Residential property prices is more equal than everyone else, like Animal Farm. This is the measure that is systemic in nature. And therefore, what they found is that if this one trips the threshold, all the other thresholds are lowered. So if you've got a residential price property bubble, not just a boom, because it's always relative to your national trend. And if you're always booming, they say that's not indicative of a systemic banking crisis. But if you're in a bubble in your residential property, that means it's spread nationwide. And therefore, the thresholds for all the other ones are lowered. And so what is your long-term trend? Oh, God, they say it's, they don't give you the answer. So I took 10 years based on reading some of the previous reports. And then they want you to do some mathematical detrending and smoothing of the data.
Well, thankfully, we're going to get to it. You did it for us, Emil. Thank goodness, because it's a little intense. Cross-border claims. That's, I think, the other one. Is that similar? That it sounds like there's a kind of a hierarchy. Residential property price is super important. What about cross-border claims?
Cross-border claims is just a fancy way of saying foreign hot money coming into the country. Whereas we all know about foreign currency denominated debt being bad for emerging markets, right? This is a little bit broader. They're just saying any money coming from outside flooding into your system, both to banks and non-banks. And if it's high relative to GDP, okay, and then grows over the next 3 years, if it reaches a certain threshold, then that means you've got too much hot money coming in. Think the Southeast Asian financial crisis, 97, 98, when you've got all this money coming in, overwhelming the local economies. Soon that money is investing in things that are not productive, speculative. And what do we see historically? These things reverse. And so that is the fifth and final early warning indicator.
And we are going to, for our viewers, we are going to show some of this as we're talking. Emil has crunched them numerous ways. We've got heat maps as well as charts. If you don't see something during our conversation, Emil will certainly be able to respond and get it to you, because I think they're really worth looking at, especially when you lay them out in the heat map when it comes to that residential property. So we'll talk a little bit of specifics, because you also are going to nicely put a summary together for, what the risks are telling you. But when you looked at some of these individual components, what was your first reaction as you started to get the kind of collated picture of what's going on? And let's concentrate on the one that seems so important, that residential property one. What was your reaction to what you were seeing on the charts and the map?
Going into it, I assumed that I would see all of the world's property bubbles trigger the threshold, and that's not what happened. So I think the audience can guess some of the names: China, Australia, Canada, property bubbles, right? No, they're property booms, according to this data. And the BIS says all these measurements are relative to your national trend. So if you're used to crazy, that's okay. You can still remain on that crazy trend. Everyone else thinks it's nuts. But if you've gotten used to it, and these things are long-term trends, a generation, a decade or more, if you're used to it and that's where you are, okay. So those countries did not register, and I was surprised by that.
Yeah. So when you put the summary chart together, though, so what do we need to look at in terms of what to be concerned about? The BIS has kind of created it so that you can sort of trip some of these wires, and I guess we are more concerned when you've got multiple early warning signs flashing. Is that the way we should interpret the data?
That's the way I interpret the data. I'd be interested to hear what the listeners and watchers think, but that's not necessarily what the BIS says. They just say if you trip any BIS indicator at any point, that's an early warning indicator. And then they say, that doesn't mean it's going to happen. What that means is that now you, as an analyst, should look into this country and see whether or not there's a reasonable explanation for it. Of course, I think we naturally, if we see a country tripping it one quarter after another, one after another, that raises more red flags than a one-off.
Yeah. So if we take a look at that final scorecard, and we can go back and talk a little bit about why countries landed there, but on the summary, the country with the most red flags was Canada.
Everyone's favorite country, other than New Zealand, Iceland, all the Scandinavian countries.
I was shocked by that.
They're such nice people. I love the Canadians. And this is where now we need to go to an expert in Canada and say, do these things make sense? So there are 5 indicators, and they're the only one that has tripped 4 of them. There's 4 other countries that have tripped 3. The only one they didn't trip was the residential property indicator, the real, by the way, these are all inflation adjusted, this residential property prices. That's the one they didn't trip. What did they trip? Cross-border claims, credit. So there's a lot of money coming into Canada. Credit gap, more debt than they are used to coming in recently. They're getting more into the private sector. Their debt service ratio is elevated relative to trend, and the household debt service ratio is elevated relative to trend. Now, here's maybe where we can say maybe there's a reasonable exception. The cross-border claims, it's not the first time that they have tripped it. They've tripped it 3 times now. And each of the previous 2 times that they tripped it was right as we were heading into a global dollar shortage, the global financial crisis, the European sovereign debt crisis, and now this, what I like to think of, the deglobalization crises that we started in 2018 all the way through the COVID crisis. So maybe it's not a sign that this is bad news for Canada. Maybe it's foreign flows seeking safety into Canada. Right. That's the reason we're seeing this particular early warning indicator trip. The other three indicators, well, then, we'll have to go to a Canada expert and say,
Yeah.
is your country over leveraged?
We have to find one first. Years and years ago, I went to cover the Canadian budget, and I can tell you don't get a lot of airtime when you're chasing, Canadian economics. It just seems so linked. It's, as you say, it seems not very risky. A lot of the Canadian market very tied to metals, to mining, and we've seen a big boom in commodities too. So I wonder if, some of those flows relate to that as well. So if you see that and you're trying to figure out, as you say, not a suggestion that there's a crisis tomorrow in Canada, but a reason to maybe look a little deeper and try to understand some of the dynamics. When you look at, if an investor was to look at Canada's rating from a rating agency, a traditional rating agency, I mean, it's A. It's, anywhere from AAA to somewhere down, the A food chain. But I mean, this would not be an indication at all that there's any risk there. You can understand why it's confusing to people to see them show up at the top of the list.
My first thought is going back to The Big Short.
Yeah.
These rating agencies haven't acquitted themselves very well, and obviously now they're never going to hire me because I've said this, and they're never going to sponsor Real Vision. But I think that's the case. It seems like a lagging indicator. The changes to the ratings seem to happen after the fact, or when it's inevitable. And this is more predictive, and perhaps that's their business, when it's inevitable and guaranteed and baked in. And this is more like, hey, keep an eye out for this. Right.
Yeah, and they've been trying, I think, trying to sort of remedy what happened and take a look at the lessons from that. But as you say, maybe it's, just the way they're structured. So if we go to the list again, and I know that, people are sort of very hastily probably reading down to see who's on it. And then I have some more questions. But so Canada tripped 4 of them. There were a handful of countries that tripped 3 of them, right? Czech Republic, South Korea, Norway, Sweden. Again, not names that people would think of when they're thinking about risk.
Exactly. Now our conversation can continue. I know that South Korea has come up in the news. I believe their central bank recently said that they needed to tighten monetary policies. And one of the reasons why they gave was risk of financial crisis. So I would just normally say, well, I don't even understand what that means. But this data confirms that they're seeing some of the same things. The ones that they tripped, credit gap, as well as total debt service ratio and the household debt service ratio.
So at least maybe they're reading, maybe they are reading the BIS data. When we were looking at this, I imagine that it matters. So this is a set of data, but you've got to put it against a lot of other criteria when you're trying to evaluate the risk. And I would imagine that a country's political system, the nature of their financial markets, how liquid they are, how they deal with bankruptcies, I would imagine that has to be taken into account.
That's what the BIS says. They say we are taking a broad brush that we have found to be predictive and accurate, but it depends on the country. For example, China comes up on this list twice. Does that mean they're going to experience a banking crisis? As Michael Pettis often writes, unlikely, because A, they have very credible regulators. B, it's a closed system. Therefore, they are able to rearrange the balance sheets as necessary with force, and therefore put off a banking crisis. Now, that doesn't mean there won't be costs, because this debt is always paid by someone. Someone in the social system is going to pay it, probably households. But it'll be amortized over many years, likely via just very slow growth. So it depends on the country, depends on the context. This is a starting point.
Yeah. You bring up China. Do we feel like the BIS has adequate information to be able to even categorize China? We often talk about the fact that, we're not really sure many people really know what's going on inside the country, or if there is reliable information coming out.
I would have to defer to Michael Pettis and ask him. He's an expert. I just read his blog post on Evergrande at the Carnegie Endowment for International Peace. Great blog post for everyone to go check out. He would be able to better comment on that. I've never heard anyone say or question the BIS data. I think they do a fine job. There are other international organizations where these questions do come up regularly. I personally haven't heard it regarding the BIS data.
Yeah, well, that's good to know. So in that group with China, for the countries that have triggered two of the warnings or the components, Hong Kong as a territory, France, China, you mentioned, Russia.
That's a surprising one. I'm sorry, Maggie, for interrupting.
Yeah, please
France. I don't think people are aware of that, but France has triggered the credit gap and total debt service ratio. And this is very interesting. This is something that Mr. Russell Napier brings up all the time. Right next door is Germany, which is like nowhere near these sort of debt levels. And then we have France, who is at the forefront internationally on having too much private debt. How are they going to deleverage within a unified currency system? This is a political question, but it is a question. The point is, this question may come up sooner than people expect, right? We're all used to kicking the can down the road. These BIS early warning indicators are saying, your country is stressed, look out. Whereas before we may think, whatever, they'll figure it out eventually. Eventually here, there's a coin flip's chance it's 3 years.
Yeah. And I mean, huge implications for policy. Interestingly, so Spain, Germany, and France are all on the two triggers, Ireland as well. But France, Germany, and Spain, we always think of, well, not Spain, but France and Germany, core Europe. And yet Italy, Greece, they're not on this. Which is when you think of debt and you know what they went through, very interesting.
Deleveraging. Same thing with the United States. They had it wrung out of them horribly, terribly. Terrible price to pay. They were in a unified currency system. They couldn't inflate their way out of the terrible debt situation they were in. And so they have deleveraged their private system. Their public system, their public debt is, as we all know, through the roof. But no, Italy does not show up here. Greece does show up once on the property measure. In fact, for 10 of the last available quarters, they have tripped the threshold every single quarter. Greece, properties. I would love to investigate. If anyone wants to invite me to Greece to investigate the property market there, yes. The answer is yes.
Yes, and try all of the different regions and compare them to each other. That is a hardship. That would be a hardship gig, Emil. And by the way, so just to make sure, as we're looking at the list, Hong Kong, France, China, Russia, Switzerland, Chile, Slovakia, Brazil, Germany, Ireland, and New Zealand. Quite a few with two.
I want to highlight a couple of them.
Yes.
Switzerland and Hong Kong. It may be unfair of us to put them on this list. Why? Safe haven. They have too much debt, but it's not their debt, right? They're advanced economy money centers that are home to international debt that their economies are not expected to service. However, how do you untangle all that? I don't know. I can't do it. So maybe they shouldn't be on this list.
Yeah, but as you say, it's good to, important to be noted and then do an investigation into it if this is an area that you're looking at, that you have in your portfolio, that you're exposed to somehow.
New Zealand is one that's pretty interesting. That one just popped up on the radar. I think 3 or 4 quarters ago, they tripped the cross-border claims warning signal, meaning a lot of money is coming in from abroad. Just a few quarters later, 3 if I remember correctly, their real residential property price index went too far. And especially the last 3 quarters it's accelerating so fast that now they've tripped that as well. I wonder if one led to the other and if it's a developing situation.
Yeah. And what's driving it? It seems, again, New Zealand kind of in an interesting position. It's harder to sort of immediately identify what that would be again. Although, again, maybe commodities have something to do with it.
Well, I was just going to say they've got a very popular prime minister. It's a beautiful country, and it's a small country, so maybe just a little bit of foreign flows. It's a English-speaking Commonwealth law country, so there's good reasons. During the Corona crisis, they were an island that was COVID-free for a very long time. That seemed to be very popular. So you could see why it's happening, but too much of a good thing apparently is bad news.
Yeah, or something that at least has to be, recognized, and the policymakers there need to keep an eye on to the extent they can. You mentioned COVID, Emil. Could that in any way be muddying some of the numbers that come up here if there were, like if you're especially if you're looking at debt? We just went through this extraordinary period. Do we know whether that impacted things or not?
It absolutely did impact things because GDP fell while debt accelerated as countries responded with wartime emergency spending. Now, this is the question that Jeff Snyder and I talk about often on our podcast, is whether or not you can turn an economy on and off and then just get back to normal. If you can get back to normal or reacquire some previous growth trend that was acceptable, then the growth may ameliorate this increase in debt that we've taken on because of COVID. But we are already at World War II era highs, right, in the private sector. Now we've added an additional emergency on top of that. So on the one hand, yeah, it's muddying the waters. On the other hand, it's the key. It's the key that maybe this is going to accelerate private debt crises that otherwise would have just continued on and smoldered. Maybe countries are going to be in over their heads because of all this extra spending, and GDP and demand doesn't come back as strongly as pre-crisis.
That's right. I think that's why it's so useful on some of them that you've done. Again, some of them we're going to see the change on a chart, but I think this is why the heat map is so great, because you can see if it is because of something like a pandemic, because it would coincide with the timing, or if this is something that was sort of running up in a problem area to begin with, and then it's just exacerbated by that event.
It's difficult days right now. It's the fourth turning. It's the end of the post-World War order. These are the kind of things that should be expected during these kind of moments in history. And maybe this is the trigger, the spark that will lead to a new social order, a new crisis in the financial system that will then filter out across the economy. So to be determined.
Yeah. So you mentioned when you were talking with Jeff, and for our viewers, I know many of them follow your work, the work you do for Eurodollar University, and listen to the podcast. So do you believe that the data that the BIS is looking at, does this incorporate a lot of that shadow banking, Eurodollar money that you both talk about? Is so hard to track, is so hard to measure, is so hard to know how much is actually out there. How does this BIS early warning indicator sort of work against that backdrop?
It's good. It's good data. It's not the BIS's fault that they can't get everything. All right. This is a global problem about identifying money. First of all, we have to define what money is, then identify it, measure and map it, and the creation of it and the distribution of it. This is a huge problem. This is a huge undertaking that unfortunately our central banks haven't done. And the BIS does as good a job as possible to kind of get a big picture view. And I'm going to come back to Mr. Richard Vague again. He said, you can't miss it. These systemic private debt crises, you're not going to miss it. You're going to see it in the data. So you don't have to get every single dollar or euro or yen out there. You can see when there's a surge well beyond normal. And that's it. You're not going to miss it. You don't need every detail.
Oh, that's good to know, because I think sometimes we worry about what is like reliable, if there's this enormous system that's hard to measure. In the brief, you sent me a backgrounder on sort of how this came to be and what the BIS talking about it when they decided to sort of put this together. And they said something that sort of struck me, and I wonder what your thoughts are on it. They said the notion, they base this off the notion of the financial cycle. And it refers to this sequence of financial expansions and contractions that can amplify fluctuations, and outsized financial booms can lead to stress and even financial crisis, right? So it's that outsized financial boom I think they're trying to measure with this, right? Is outsized, that idea of outsized, is that impacted at all by technology and what we're seeing happen with markets, the people who are able to participate in them, the speed of the flow of information? Has that in any way changed what outsized looks like now?
Perhaps outsized is bigger, now. And I'm thinking of the Bitcoin bubble leading up to 2018. I've done a study previously where I compared that bubble to all of history's most famous bubbles. And according to at least my data, that was humanity's greatest financial bubble leading up to 2018. But no, is it technology? No, it's not. It's human nature. It's human nature. And the best treatment on this is Rudyard Kipling's The Gods of the Copybook Headings. It's a short poem written in 1919, and he talks about how we keep repeating the same mistakes, how the gods of the marketplace seem so appealing, so appealing. The future is going to be wonderful. And then we get in over our skis and we realize no. And this happens over and over and over. Previous generations thought it's never been more advanced than right now. Well, technology keeps increasing, but we don't change. It's human nature. And right now we're at that point where we've pushed financialization probably too near its limits, and probably the decades ahead are going to be less financialized. Something like what we saw after the Second World War, when they too had to answer for a huge towering debt crisis.
Do you when you talk to people, do you feel that they dismiss the risks out there? You know, it's easy when you're, and I'm thinking about the BIS doing this early warning indicator. It's so useful, but I think there are so many people, especially when human nature comes into it and greed or the desire for profit, however you want to frame it, gets involved. People tend to become numb to the warnings. They just don't want to hear it because they're making money on the way up.
That's absolutely true. And you never quite know when the bubble is going to pop. I remember a great quote here I heard on Real Vision that bubbles can go to unimaginable heights and then double from there. Yeah. So it's human nature. Why would I listen to a negative Nancy and a complaining Charles about that there's too much debt when I can keep making money? Sure. Keep your eyes open. That's what this data is saying, especially for these countries.
Yeah. The BIS themselves gives a couple of caveats. Unfortunately, in some areas, in some media spaces, we tend to be hyperbolic about this and, the sky is falling and we grab the most sensational headline. And then that's when people sometimes turn off and don't listen to some really useful information. And so the BIS does take some time to give some caveats, right? And one of the things they say is this only has two settings, on and off, when it comes to, so you've either triggered it or you haven't. But you seem to have sort of split the difference a little bit when you tried to do your heat map.
Well, what do you mean exactly? I mean, yes, it's on and off, but are you saying that it's increasing relative to its own history? I'm not quite sure I understand.
Yeah, I don't.
Forgive
this is
me,
a
Maggie.
caveat that they gave, I guess. So just because it's on, I guess they're cautioning that the level of degree, or they're not really picking up the sort of momentum change.
Yes, they're saying if it's triggered, that's enough. It doesn't matter if you keep going well above the trigger. Once it's triggered, that's it. And of course, that's a dumb reading, but they say that's what it's supposed to be. It's supposed to be for policymakers. We're supposed to be able to walk up to a politician and say, we have too much private non-financial debt in the system, and here are the possible consequences. And then if the politician asks you to explain it to them, you don't want to be giving them, well, this threshold, context, contingency, X, Y, Z. It's just a simple yes, no. And that's good enough for the investigation to start from there.
Emil, sometimes when people see this, see these warning signs or see things that are happening or countries they'll say, oh, well, it's different now. Things are structurally different. The same rules don't apply. Do you tend to be a skeptic about that argument?
Yes, I am. The most of the books behind me are about that very same question. That it's not different this time, that it's human nature, and that it repeats with just different characteristics, different shades, different feathers that we're wearing, but it's still the same human story and just playing out in financial markets over longer periods than perhaps humans are used to, right? So this could be taking place over a decade or a generation or even 4 generations. And so we lose context. We think it's perfectly normal. That's why, these studies are helpful to take a long view.
Yeah. I want to flip back to the countries for a second. And one of them that also jumped out, and they have three components triggered, Norway and Sweden. Again, this is the thing about systemic risk. You never know where it comes from. We've certainly seen that play out before. It does not have to be a massive economic power that's the source of a systemic problem. But is it possible, even though they've triggered three of the criteria, is it possible that they're sort of a one issue offender, that there's something going on in those, say, Nordic countries in this case, that's responsible for influencing several of the underlying components?
It's a possibility. I have to plead ignorance and ask the audience to maybe have suggestions in the comments below and offer us some reasons why these two countries, both Scandinavian, both neighbors, similar in character and culture, have triggered these warnings at this particular time. And the ones they've triggered are the credit gap to GDP ratio, the total debt service ratio, and household debt service ratio. So it seems like their private sector has too much debt relative to their GDP. And is this normal? Why? I don't know, but that's why, we would turn to the experts from here.
Yeah, I think it is so interesting because they have reputations about being pretty prudent. They have very active sovereign wealth funds. So it's so interesting to me that that's the case. And I hope we do get a lot of people weighing in with some thoughts or insight. And I asked you, why isn't the U.S. on here? Because it feels like policy-wise but your explanation about the sort of painful deleveraging that happened is why some of the countries that would be maybe usual suspects are not on here. But were you surprised at the countries that were on here? And I only went in the top 10. There's a whole bunch with one triggered. I concentrated more on when you gave us the summary list of, the ones that are triggered 4 or 3 or 2. But were you surprised at some of the countries on here?
I was, and I wanted to dismiss them. No offense to all my fans in Sweden and Norway. I'm like, well, whatever. But then I remembered Iceland, 2007, Ireland, 2008, right? We've got these countries that then do trigger systemic consequences. They're part of a domino chain. It can happen even if they're small countries. Let's think about the Asian financial crisis. Malaysia, Thailand, Indonesia.
The Thai baht. No one even knew, there are corners of the world that didn't even know what that currency was until it wreaked havoc.
It can expand from there. The consequences can reach advanced economy money centers, and then it could be a global systemic crisis. Maybe, who knows? But the point is, if you're invested in these countries, you should be aware of it. And it's good to keep an eye out on it, just if you're a global investor, to see if there are many more countries popping up all of a sudden.
That's right. Well, and it's worth saying again, we're going to share all this information. Emil went and took all of that raw data and compiled it and collated it so that we can all look at it and understand it. But I feel like, Camille, we sort of gave a call of action to people. Take a look at the findings, and then let's begin a conversation about weeding out which ones may have reasonable explanations that can make us sleep a little better, and then maybe which ones this is really, a flashing light that we need to be paying attention to that maybe wasn't on the radar. It concerns me that some of these countries are also would not be expected, and that maybe are, when you're talking about counterparty risk and you're talking about their assets or exposure to them being everywhere, these are kind of safe, steady, developed countries that are on this list.
France, Spain, Germany, Sweden, North Korea, Norway, and South Korea. Absolutely, I agree. But that's where the crisis can emanate from, advanced economy money centers, right? It could be because an emerging market tips over, but just because an emerging market tips over, that usually doesn't spread throughout the whole system unless it affects a particular advanced economy money center, which is a hub that disperses capital around the world. So yes, seeing these advanced economy centers already on this list can be concerning. Then again, we could also say, maybe those countries are the only ones that provide good, reliable data. So therefore, maybe it's just a selection bias. I don't think it is, actually, because I think it's the advanced economy money centers that are over their skis on total private debt. The emerging economies are not. It may be paradoxically, very strangely, that emerging market economies are going to be the safer place to have your money should anything tip over?
Yeah. Some people have been suggesting that hasn't happened yet, but maybe the timing, maybe the idea was right, but the timing was off. I feel like there will be a part 2 to this as well, Emil, because I feel like we put all this fantastic information that you compiled for us out there, and we're going to have a lot of interesting conversations now as people get a chance to dive in, see what they can make of it. And then let's come back. Let's come back again. I know you're probably going to take all of this too, and do your own investigating. So let's see what we come back with from the audience, and figure out whether we can make a distinction between some of the real concerns and threats and then some maybe that have an explanation that make us happy. Will you come back and do that with us?
That's very kind of you, Maggie. I would love to. But first, let's see what the letters to the editors say, right? The death threats, ransom notes, hate mail. Let's review it all. And if it's much more than usual, then I understand. But I've got, a few of those is normal.
Yeah, we'll see what we get, but I have a feeling we know which way it's going to land. Emil, thank you so much for doing this really, really difficult legwork. We appreciate it. And thanks for coming on and sharing it with all of us. And we'll talk about the results soon.
It was a real pleasure. Thank you, Maggie.
Great. Emil Kalinowski for us. Thank you so much for joining us. Take good care out there, and we'll see you soon.